Hey, what's up everyone? I think I found another stock with 2x potential. So I'll present the idea and then you can be the judge. Please remember that this is not financial advice. I'm just sharing what stocks that I'm buying and why. The company is General Employment Enterprises, and I'll just call them G Group for short. I think they're really undervalued. So I'm estimating 50% upside in 1 year and likely a 100% upside in 2 years. They're currently trading at 54 cents a share. I would try to get in under 60 cents a share, and you'll see why later in this video. They're a $58 million market cap company, so they're tiny. They hold currently $10 million of cash, and they're about to generate $10 to $12 million of cash every year starting in 2022. So when you really think about this, in their space, other companies are trading at 10 to 15 times earnings. G Group is trading at 5 times cash flow. So if they're able to grow their business, it's going to be pretty hard for the market to ignore how severely undervalued G Group is. What I like about G Group is that their business is not complicated. They're an employment staffing company, and they operate under several different brands. They had made acquisitions in the past and kind of just had kept their brands. They have 28 different locations spread across the United States, 1 headquarter in Jacksonville, Florida, and 3 virtual locations. So I would say the large majority of their revenue, 90% I believe, is focused on higher margin staffing positions. So they're mainly focused on trying to place job positions in IT, finance, and accounting. So a larger comparative company that is similar to G Group would be Kforce. Kforce is a 1.4 billion market cap company, I believe. They're trading at, I think, 23 times earnings and at least 10 times cash flow. And I'm not saying that G Group deserves to trade at the same multiple as Kforce, but what I'm saying is if G Group can continue growing, their valuations will approach Kforce. And this is why I think that this company can double. The opportunity exists today because they've really had a rough history. So in 2015, when G Group merged with Scribe Medical Solutions, the current management took over. And for every acquisition that they made in 15, 16, and 17, they added on a little bit more debt. And the acquisition that they made in 2017 was a really big one. And the debt structure that they were using was actually really expensive debt. I mean, they were paying north of, I think, 10 to 15%. And so I get why they were doing this. If you look through their previous financials, you can see that they were really just trying to scale. And their cash operating income was actually starting to scale up, and it was working. And so in 2019, they restructured, consolidated a little bit, and then when COVID hit in 2020, they just got absolutely crushed by the interest expense. It eventually just outgrew them. So for the past 2 years, they've completely restructured the company. In 2020, they got rid of all their subordinated debt. They settled it for pennies on the dollar. And then they got rid of all their preferred stock. And then in April of 2021, they did this massive dilutive share issuance. I think they issued about $96 million shares at 60 cents a share. And so this is why I say you want to get in under 60 cents. And so with all of that cash, they paid down all of their debt. And they had $17 million of remaining PPP loans that were just forgiven in December of 2021. So they're currently operating clean. They've completely restructured the balance sheet. So what we're left with today is a company that doesn't look like they're making much money, but since they don't have any more debt, you can kind of just focus in on the operating income. And if you add back all the non-cash expenses, they'll generate about 12 million of cash going forward. And they want to use this cash and their existing cash to grow the business further. I would say there are three things that give me concern. The first one is a possible economic recession. In a recession, people don't hire as much, and so staffing companies will not make as much money. That one should be obvious. The second point of concern is management. So they're the same people that, got them into all this debt, and they're the same people that got them out. And so kudos for solving the problem, but the existing shareholders actually, paid a pretty big price for it. And then we have to closely examine the CEO, Derek Doohan, and really understand his DNA, I would say. And the reason for that is because he's not a rookie in this space. He's actually had more than 2 decades of experience in the staffing industry. So here's a flavor of his past. He made partner in PricewaterhouseCoopers by the age of 29. He was a CPA. In 1992, he helped facilitated the merger of 4 staffing companies, and that became known as AccuStaff. In 1994, he took AccuStaff public, and he also became the CEO. And he grew AccuStaff's sales from 1994 of $137 million to about $1.3 billion in 1997. So over the course of 3 to 4 years. He did him and his team did this through organic growth, but mostly just through a crazy amount of acquisitions. So they did 10 in 1995, 29 in 1996, 28 in 1997. And so in 1998, they consolidated a little bit, sold off some divisions, renamed the company to MPS Group. And then in 2009, MPS Group was sold to Adecco for $1.3 billion. So he took a small little company, took it public, grew the business massively, and then later sold it off. And I think that's what he's trying to do with G Group, except he did it just a little bit too fast. And I also think he just kind of used the wrong capital structure. And so right now, with the stock being severely undervalued, my hope, and I hope he doesn't do this, is I hope he doesn't issue more shares to do these purchases and acquisitions. My hope is that they have 10 million in cash. They're going to generate 10 million more. They can make small bolt-on acquisitions. And when stock prices normalize back to $1 and become fairly valued, then he can issue shares if he wants to grow the business. The third point of concern would be, if you think about staffing companies, I would say maybe the 2 most important things are scale and customer service. Scale they don't have, but they're growing, and hopefully one day they're going to achieve bigger and bigger scale. So that I'm not too worried about. Customer service is really hard to gauge, and the only way I can really gauge them is to find public reviews of their brands or their branches. And that's pretty sparse. I can't find anything on Yelp. I did find 2 websites, recruitsy.com and clearlyrated.com. And on clearlyrated.com, they have really good reviews and they're plentiful. But What bothers me is I can't find reviews on larger staffing companies, you know, like Robert Half or Kelly Services or Adecco. And it kind of makes me question a little bit the validity of Clearly Rated, because, you know, why wouldn't large staffing companies have any reviews? Because they have reviews on Yelp. So, you know, maybe that's just the nature of the beast. I mean, public customer reviews are pretty sparse in general for the staffing companies. So, you know, again, maybe that's just the way it is. But it would really give me more comfort if I could find more customer reviews on these brands and G Group. So that is my thesis on G Group in a nutshell. Let me know what you think. I hope you liked the video. I hope that you have an opportunity to make some money, and I will see you next time. Thank you.